Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have completed the basics of CVP analysis. What is the meaning of the term CVP analysis? What is the importance that I have discussed in the first video of this unit number 5. And in this video I'm going to explain you about the break-even analysis. What do you mean by break-even analysis? What are the assumptions of break-even analysis? Advantages, disadvantages of break-even analysis, then the different concepts used in CVP analysis like contribution, profit volume ratio, margin of safety, break-even point. All these things I am going to explain you in detail, so watch the video till the end. Because the problems are based on these concepts. If you do not understand the concepts, it will be difficult to solve the problem. That's why this video is very important. So if you have not watched the first video, go to the playlist of my channel, select the subject, accounting for management. Select the video of CVP analysis. Be clear regarding the meaning, then you can continue in this video. Take the screenshot of the points which I have written on the board, then I'll explain all the points in detail. Now, first of all, the meaning of the term break-even analysis. The break-even analysis has two different meaning, from narrower sense and from broader sense. From narrower sense, break-even analysis means finding out the break-even point. The point where there is neither profit nor loss. And the broader sense of break-even analysis is where we find out the profit at different levels of activity. So here the break-even analysis refers to the study of cost volume profit analysis, CVP. In the previous video I explained you that normally it is used in a synonymous way, that CVP and break-even analysis one the same. But technically it is not same. Break-even analysis is only one of the part of CVP analysis. Actually CVP analysis is a very wide concept. In that CVP analysis, one of the part is break-even analysis, and it refers to the study of cost in relation and the possible impact on revenues and volume of the firm. That means, what is the relationship between cost, volume and profit? That means if volume is changed, what will happen to the cost? What will happen to the profit? Similarly, if cost is changed, then what will be the effect on the revenue? What will be the effect on the profit? Like this, we want to study the relationship between cost, volume and profit. And break-even analysis is concerned with determination of the particular volume at which the cost will be equal to revenue. In narrower sense, the break-even analysis is concerned with that level of activity at which the total revenue and total cost will be equal. That is a small definition of the term break-even analysis. Now, assumptions. When we apply break-even analysis, we have to assume certain variables. So, what are the assumptions of break-even analysis? The first one, all cost can be divided into fixed and variable. So, before applying the break-even analysis, it has to be clear that which are the costs are fixed cost and which are the cost as variable cost. If we cannot distinguish the cost between fixed and variable, we cannot apply the break-even analysis. So complete break-even analysis depends on the segregation of cost between fixed cost and variable cost. Secondly, fixed cost remains constant, whereas variable cost changes with the level of output. What is the nature of fixed cost? We have to assume that fixed cost is going to remain same, whatever be the level of activity, whether we produce 1 unit, 2 unit, 10 unit, 100 unit, any number of units, the fixed cost is remaining constant. And variable cost will change proportionately with the output. If the output is more, variable cost will also be more. If the output is less, variable cost will also be less. That is the nature. Third one, selling price remains constant. Another assumption of break-even analysis is we have to assume that selling price is not going to change. The selling price is going to be fixed. The number of units produced and sold will be same. Another thing. That means the production and the sales are constant, are same. Then next one, there is no change in the operating efficiency. Whatever present operating efficiency is there, the same operating efficiency is going to continue in future. There is no change in the operating efficiency. That is the assumption. Last one, there is only one product. Normally, break-even analysis assumes that the business produces only one product. In examination, they may ask you what is break-even analysis and what are the assumptions. So just know what I have explained, that will be more than enough for writing an examination. Now, what are the advantages of break-even analysis? There are many advantages to the management by applying this break-even analysis. First one, break-even analysis can be used to determine the sales volume to achieve a given amount of profit. Normally, management will set a target profit. For example, management will say, next year we want to earn a target profit of 10 lakh rupees. So how much sales we have to conduct in order to achieve the target profit of rupees 10 lakh? So this question can be answered by applying break-even analysis. How much sales is required to attain a given profit? Then margin of safety can be determined by using break-even analysis. I'll explain you the term margin of safety. It is the excess of actual sales over break-even sales. So over and above break-even sales is called margin of safety. So by applying break-even analysis, we can find out the margin of safety. Next, break-even analysis can be used to forecast the future cost and revenue. The planning regarding cost and revenue or forecasting can be done by using break-even analysis. Break-even analysis can be used to control the cost. Another important advantage of break-even analysis is by using the technique of break-even analysis, we can be able to control the costs. Next one is the break-even analysis can be used for profit planning, just like CVP analysis. The CVP analysis is a profit planning technique. So similarly, the break-even analysis is also the technique used for profit planning. Last one, break-even analysis can be used for sales projection. Projection means estimation. We can estimate the sales of future by applying the break-even analysis. These are the few benefits or advantages which we get by applying break-even analysis. Now, don't think that we have only advantages. The break-even analysis also suffer from some limitations or demerits or disadvantages. So what are the demerits of this break-even analysis? First one, it is not dynamic because everything is assumed as constant. See, future is always uncertain. There is nothing fixed. Always everything will change. Number of units, selling price, cost, all these variables may change in future. But here the assumption of break-even analysis, everything is constant, fixed. So next one, it will not give true results in a dynamic situation. If the situation completely dynamic means ever changing. Lot of changes are going to take place in the future. So in that dynamic situation, if we apply break-even analysis, we will not get the true results. It is limited to short period only. Another very important limitation of break-even analysis is this technique is fruitful, beneficial only during short period. Because during short period we can classify the cost into fixed and variable. Only during short period. In the long run, all the cost will become variable. There is no fixed cost in the long run. So that's why the applicability of this break-even analysis is limited only for a short period of time. Next one is, it does not take into consideration changes in technology. Nowadays, the future is completely uncertain. Number of changes are taking place in the technological advancement. Due to the advancement of technology, the production will change, cost will change, revenue may change. So in this situation of dynamic technological changes, it is difficult to apply break-even analysis. So what I have explained, what is the meaning of the term break-even analysis, what are the assumptions, what are the merits and demerits. Now, there are some concepts which are used in break-even analysis, which have their own technical meaning. So every student must know the meaning of those technical terms. So now I'm going to explain you one by one. And apart from that, in examination, in short questions, these concepts will be asked. Right? So give more concentration. Now, first one is contribution. Contribution is the difference between sales and variable cost. From sales, if we deduct the variable cost, then we get the contribution. So, contribution is defined as the difference between sales and variable cost. It is defined as the excess of selling price over variable cost. Suppose the sales are 10 lakh and the variable cost is 4 lakh. So, from 10 lakh rupees sales, deduct 4 lakh rupees variable cost, the remaining 6 lakh rupees is called contribution. And this contribution is available for meeting the fixed cost, and the resulting amount will be the profit. So from contribution we subtract the fixed cost. The resulting figure is called the profit. So the contribution is available for meeting the fixed cost and the remaining will be profit. So what is the formula of contribution? Contribution is sales minus variable cost. In simple words, remember the formula, because in the coming videos I am going to explain you the formula, the problems on CVP analysis. There at number of times you come across what do you mean by contribution, how to calculate contribution. So contribution is equal to sales minus variable cost. C is equal to S minus V. And contribution per unit. Sometimes you are required to calculate contribution per unit. So selling price per unit minus variable cost per unit. That means contribution can be calculated either in total or in per unit. If you want the total contribution, total sales minus total variable cost. If you want contribution per unit, selling price per unit minus variable cost per unit. And one more formula is there for contribution, fixed cost plus profit. C is equal to F plus P. Any formula you apply, the same answer you will get. Whether you apply S minus V or you apply F plus P. This is contribution. The next very important concept is PV ratio, profit to volume ratio. So the PV ratio expresses the relationship between contribution and sales. So this PV ratio shows the relationship of contribution to sales. Example, in a business the contribution is 4 lakh and the total sales are 10 lakhs. So we calculate PV ratio 4 lakh divided by 10 lakh into 100, 40%. That means for every 100 rupees of sales, we are getting 40 rupees as contribution. So PV ratio is also called contribution sales ratio, CS ratio. Now PV ratio is very important for studying the profitability of operations of a business, very important. This PV ratio mainly applied to find out the profitability of the firm. That means higher the PV ratio, better it is. Because suppose if the business is producing a number of different products, they will calculate the PV ratio of every product separately to find out which product is more profitable. Right? The next one is any increase in contribution would mean increase in profit because the fixed cost remains constant. Higher the contribution, higher will be the profit. Because in between profit and contribution we have the fixed cost, and fixed cost will remain same. So even if contribution is increasing, the fixed cost will not increase, fixed cost will remain constant. That's why profit will be higher. So higher the contribution, higher will be the profit. In case multi-product organization, PV ratio is of vital importance for the management to find out which product is more profitable. Just now I told you, normally nowadays, most of the companies are producing multi-products, different products. In that circumstance, they calculate the PV ratio. Whichever product has a higher PV ratio, that product is assumed to be more profitable. Now, management tries to increase the value of this ratio either by decreasing the variable cost or increasing the selling price. So, simple words, PV ratio can be increased either by decreasing variable cost or increasing the selling price. Now, what are the formulas for calculating PV ratio? The formula for calculating PV ratio is C by S into 100. Contribution by sales into 100. So in place of C, we can write S minus V. Already I told you C is equal to S minus V or C is equal to F plus P. So in place of C, I can write S minus V by S into 100, or in place of C, I can write F plus P by S into 100. And one more formula for PV ratio is change in profit by change in sales into 100. If the data is given for 2 periods, example 2 years, last year and current year data is given, so we can find out the PV ratio by applying the formula change in profit divided by change in sales into 100. So these are the formulas for calculating PV ratio. Next concept is margin of safety. Very important. Margin of safety is the excess of actual sales over break-even sales. Example, if the company breaks even at 10 lakh rupees, that means at 10 lakh rupees of sales, no profit, no loss, break-even sales. Now actual sales of the company is 14 lakh. At 10 lakh rupees, company breaks even, but actual sales are 14 lakh. So how much is the excess of actual sales over break-even sales? 4 lakh. That 4 lakh is called margin of safety. So margin of safety, the formula is actual sales minus break-even sales. Suppose in my example, just now I have given the example, 14 lakh rupees is the actual sales, 10 lakh rupees is the break-even sales. So 14 lakh minus 10 lakh, 4 lakh rupees is the margin of safety. One more formula is there, profit by PV ratio. Any formula you apply, whether actual sales minus break-even sales or profit by PV ratio, you will get the same answer of MOS. Now, the soundness of a business is measured by the size of MOS. If in a business the MOS is more, that means financial strength of the business is more. Higher the MOS, better it is. Because from the MOS, that means the company will get profit after BP. So as long as our sales are more after BP, the profitability will increase. Next, thus MOS serves as an indicator of the strength of the business. By seeing the MOS, we can be able to judge what is the financial strength of the business. Higher the MOS, better it is. Now, last topic I am going to discuss in this video is break-even point. Simply, it is called BEP. So BEP may be defined as that point of sales value at which total revenue is equal to total cost. Simply, the break-even point is the difference between sales, total sales and total cost. That means both are equal, both are equal. When a business total sales and total cost both are equal, then profit will be 0. Example, in our business the total sales are 10 lakh and the total cost is also 10 lakh. We are spending 10 lakh and we are getting 10 lakh means no profit, no loss. This situation is called break-even point. So if it is a point of no profit, no loss. A business is set to break even when its total sales are equal to total cost. The BEP can be calculated by some formulas. Remember one point, the break-even point can be calculated either in units or in amount, rupees. So if you want to calculate break-even point in units, the formula is fixed cost divided by selling price per unit minus variable cost per unit. That is the BEP in units. Now after calculating BEP in units, if you want BEP in rupees amount, then whatever BEP in units you got, multiply by selling price per unit. Multiply BEP in units into selling price per unit, you will get BEP in rupees. One more formula is there, BEP is equal to fixed cost by PV ratio. This formula will be frequently used. By using this formula, we can get BEP in rupees, fixed cost by PV ratio. One more formula is BEP is equal to F into S divided by S minus V. F into S, fixed cost into sales, divided by sales minus variable cost. We'll get again BEP. Any formula you apply, you'll get the same answer. Depending on the situation, depending on the information given in the problem, we apply that formula. Lastly, BEP in rupees is equal to actual sales minus MOS, margin of safety. From actual sales, deduct margin of safety, we will get the break-even sales. So these are the formulas for break-even point. That's it. So in this video, I have explained you about what is break-even analysis, what are the advantages, disadvantages, assumptions, then different concepts like contribution, profit, PV ratio, then margin of safety, and lastly break-even point. So inshallah, we'll continue the next topic in the next video. So if you are satisfied, give a like to the video, share my channel in your groups, subscribe if you have not yet subscribed, and buy the super thanks below my video.